Hello, Per. It's great to have you on for our Good Investing Talks. How are you doing?
I'm fine, thank you. How are you?
I'm good. I'm happy to have you here and have the chance to talk with you about Vostok Nafta, Vostok New Ventures, and VNV Global, to get to know the company a bit better. And you've been 20 years in the company, I think, or already 21. Is this true?
Yeah, it's of that order. Yeah, September. I joined September 2000. So
then let me start with a bit of a challenging question for the beginning. What were your biggest mistakes in the times you've been at Vostok? But before you answer, I want to use the time to just show the disclaimer and show some information, and you have some time to think about it. You already know the message from the disclaimer I'm giving you. All we are doing here is a qualified talk. It's no advice and recommendation. And always do your own work. And at this point, I also have to disclose that I'm holding a position in VNV Global. So I might be a bit biased. So take all of my interviews and this talk from me as me being a shareholder. Then coming back to you, Per, what is your answer on my bit challenging question?
There's too many answers, I think. But I mean, we're, I guess, all throughout these years we've been exposed to volatile markets, and especially as we were very focused on Eastern Europe and especially Russia for many years, it's been a volatile market, and you become absolutely mad if you start to trade with a rear view mirror, but if you allow yourself that and you look at your mistakes, then of course there are certain points of time where you should have not stayed. You should have exited. Russia has gone to zero twice, at least during my presence there. So there's been to see when things are getting out of hand. But at that period, we were also involved in the public markets in Russia, and we are very, very long-term investors. And the good thing about doing what we do now is that you have to be prepared for volatility, but we're not traders. We are long-term investors. So that's one thing, and that springs to mind. So to sort of be mindful of macro volatility. And the other one, I think, is that I think we diluted ourselves many times too early in what we do today, in that we let other shareholders in at a too low valuation. I think that's especially relevant for Avito, which was our large holding, the Craigslist, if you will, of Russia, and that when that company eventually was sold, or when we exited, we owned 13.5%, but we were basically had the opportunity to own much more than that. We diluted ourselves along the way, which was a bad investment. But it became very good in the end, and the IRR was very good, but it could have been better.
Let's take the chance for the beginning of the interview to look a bit back in your history, and I want to do this with 3 snippets from your annual reports. I've taken the portfolio from 2010, 2015, and 2020. I will share them with you in a second. Here you have the portfolio from 2010, and I hope you already see it. It are the early signs that you're turning into a tech investor in this portfolio. I will also show the portfolio of 2015. There, Avito is one of the biggest holdings, but you also had some of the tech investments, and the portfolio of 2020 is here. You don't have a pie anymore, so it's a different way of presenting it. But maybe let's go back a bit into the portfolio of 2010 and help me understand where you were coming from in this time as Vostok Nafta, and how also this kind of pink part of the portfolio became your biggest part of the portfolio. Why did you, let me say it like this, fall in love with this tech and Avito investments, or Avito-based tech investments? Maybe let's try it like this.
No. Where we came from is, of course, that this company was founded by a Swedish oil and mining entrepreneur called Adolf Lundin, and he had become liquid for the first time in his life in the early 90s, and that coincided with Russia becoming Russia again and not the Soviet Union, and especially relevant for capital markets. And he grew very fascinated with that you could sort of buy the assets that he was drilling after in a very expensive way. You could buy those very cheaply on the Russian stock exchange. So he used the liquidity that he'd received from an exit that he'd done in Argentina to buy large parts of what was shares in the newly privatized industry from the Soviet Union into the very young Russian capital markets. And then he formed Vostok around that, and Vostok then was very focused on his type of sectors. And then what you see there in 2010, was it right? Yeah,
I will show it again.
That's we have a large remnants. I think the largest source was TNK Holding, which is an oil company, and there's large mining assets also present there in different within different commodities. And so the bulk of the portfolio was still sort of very heavily exposed to the traditional sectors of where we came from. But the pink part is, I guess, me starting to apply what has always been very important for us, and all the way from the mid-90s to today, is to have a portfolio that our typical shareholder cannot get exposed to themselves. And Russia in the 90s was very difficult to buy Russian stocks. It took 2-3 months to settle. There were no ADRs, and so we were like T+3 exposure to Russia. And with time, sort of Russia became a more normal market, and anyone could sort of trade it, and anyone could analyze it, and we started successively sort of exiting the parts of the markets which were easy for anyone to access, and that led us to starting to look at private opportunities. I guess around about 2005 we started doing private investments, and there was a general skepticism around Russia. Can Russia ever become a normal country and a normal market? The Russians consumers, do they really want to consume the things that we do in the West? And we applied that to this concept of what works in the West also works here in Russia. And so we invested into business models that started to emerge in Russia that we saw were already very well spread and very loved by consumers in Western Europe and the US, etc. And so that was the starting point for that pink part of the portfolio, and there were different sort of different aspects of that. But the two that sort of grew and became sort of very important for us was Tinkoff Credit Systems, which started as a credit card issuer, a consumer finance bank with a credit card as its main product, which over time has developed into Russia's absolute leader in terms of a fintech bank, and the other one was Avito, which is the dominant online classified player in Russia.
And when did it make click for you that this is the way to go in this investments and to divest from the oil assets?
Well, I guess it started around the time of that annual report being issued. Those non-tech investments are really sort of, that was the frontier part of the Russian sort of listed capital markets, and the final decision was taken in 2012, where we sold the entire portfolio and gave that money back to shareholders, and in the autumn of 2012. And from then we became a pure investor into private companies. But of course, then we had we still had a handful of private companies which were exposed to, not tech sectors, forestry and farming, and those eventually became listed, and we distributed those listed assets to our shareholders and became more pure tech around about that time. And then in 2013-14, we decided to focus our efforts on the Avito type of investments, the classified part, which we define as, you could describe them as businesses with the potential of very strong network effects, and we can come back to that. But we had, of course, a holding in this fintech play. That fintech play listed in London. It did an IPO in London in November 2013. And so we sold most of the shares that we had into that IPO, but we still retained some shares. And if you remember, 2014 was a very volatile year certainly for Russia. Oil price tanked, which was negative, and then also Russia had this whole Ukraine mess happened with Crimea, etc. So listed Russian assets went down a lot, and so we didn't think it was good for our shareholders to sell the rest of this fintech bank into the market, because the price had fallen a lot, and at the same time we also had investment opportunities around the fintech space that we thought were interesting. So what that led to was that we spun off the fintech portfolio and the opportunities into separate Vostok that was originally called Vostok Emerging Finance, and that happened in 2015. So from 2015 and onwards, we were pure network effects company in what is now called VNV Global.
What did it mean for you to relearn and unlearn certain things in investing? Because investing in oil and forest assets and infrastructure assets is different to network effect platforms and the internet.
I think the common denominator is, the ability to think and expose yourself to risk, right? And then that it's okay to take risk. And I mean, I've been brought up, and the culture of this company is an ability to take risk, but only take risk if you have the reward to compensate. So I think we live and die by thinking about risk reward, and that's very similar regardless of which asset you invest into. And of course, Russia was visibility into Russia becoming a normal consumer place, I guess, was lower in the mid 2000s than it is now. Now there is full visibility into it, and so you could say that we applied sort of our risk appetite into that. So in that sense, it was natural. But on the tech side, I was a small shareholder in the Swedish version of eBay from the early 2000s, I think like 2003 probably, and I was on the board of that company. It's a company called Tradera, and in 2006, eBay bought Tradera, and moved in their own management. And the old management, they were free to go and do business only in countries where eBay wasn't present, and such a country was Russia. So I convinced the guys to move to Russia to apply their knowledge from the tech world into sort of what was happening in Russia. I bought a Russian business that was like an offline going to online business in Yellow Pages, and they started there. But as with good management, they quickly understood that this wasn't going anywhere. And they looked at an eBay model, but then they eventually settled for a classified model. And out of that came Avito.
That's quite interesting, this move. If we take a look back at your portfolio and look at 2015, you already see what is now part of your name, the global footprint. In 2015, you still had a strong Russian footprint, but there were more sprinkles coming on for global companies like BlaBlaCar or Get. How did you develop this global way of investing, and what helped you to become a global investor then instead of a niche investor for Russia?
Yeah, so when we took the decision, and this is, I guess, around 2013-14, and eventually culminated in 2015 when we spun off the fintech portfolio. I mean, 2012 we sold everything that was listed, gave that money back to shareholders, and we took the decision in 2013-14 we should only do Avito type of investments, and then eventually we spun off the fintech portfolio. But around that time, we also understood that, yeah, that's a good decision. We'll apply what we've learned from having been part of Avito from the very first day to new opportunities. But Avito was so dominant in Russia, so there's nothing else to do in Russia. So at that point in time, it became natural to open up the geographical sort of focus to elsewhere. And so we applied that initially. We applied that to other emerging markets, feeling that developed markets we were not ready for. But emerging markets, since we've been around Russia for such a long time, we knew, we felt we knew, and I think we knew, what's important when you invest into those markets. So we started looking at other emerging markets in our time zone. And that led us to a few investments in the Middle East, which is sort of similar to Russia. It's often misunderstood. We only think of it as desert, oil, and violence, but it's a large middle class there that's growing too. I'd been brought up in the Middle East as a kid, so I felt comfortable in that part of the world, and so we started looking there. But with time, we found that there were also opportunities which fitted sort of what we do in more developed markets. And our first investments into more developed market, one was Delivery Hero, so which is essentially of Germany, and BlaBlaCar of France, where we saw very, very similar dynamics to Avito, very clear network effects, and we also saw that they had not been fully sort of perhaps understood by markets, and hence got involved in those two. And with those two, then we felt more and more comfortable. We got more and more deal flow from I guess all over the world, and we capitalized on some of that deal flow. The opportunities came elsewhere than Russia. We still look at Russia. We still do deals in Russia, but it's just that the larger set of opportunities have come from elsewhere.
Investing is partly also about networking. And how did you go about to build your global network for VNV?
Well, I think Avito there has helped a lot as well. Avito became such a large company, and I mean, really one of the leaders, and in the global sense in the online classified industry, and us being part of that since day one, and me being part of Tradera earlier than that, and of course the team of Avito being part of Tradera. I think and in the mid 2000s, online classifieds wasn't really an industry that anyone invested into, right? It was Craigslist was private, Schibsted was still, newspapers, Naspers was doing other stuff, and so I guess we were early in that space. And as the Avito grew, the sector sort of grew in general as well, and then I guess we became well known for being around. We became well known with sort of Avito becoming the kind of company it is today. I mean, a large, very well run company.
As you went on this journey, you always, as a listed company, you always have, like, if I think around 10,000 people standing behind you, or institutions and people, your shareholders. And it's also quite interesting. I want to show you a next chart I also did get from your annual report. Sorry, here we go. And it's a list of your shareholders that also changed since 2010 a bit. Here you see 2015, and here you see 2020. My question is, what I found quite interesting in your list of shareholders, if you look at the 10 largest shareholders, you always had a high concentration of shareholders, over like 58 or 70%. How does this help you to run the company?
Well, I think we run the company regardless sort of the concentration of shareholders. I mean, of course, for many years, our largest shareholders was also the same family that started the company. So they populated the board as family members, and they were very involved in the decision making. And so it's always been very natural for us to have one large shareholder. They eventually sold their shares to a US outfit called Luxor Capital, which Luxor was very focused and very attracted to online classified Schibsted and those type of industries, and still are. And they were also, they're not obviously not a family, but they were also quite active, not directly because they didn't sit on the board directly, but they were very sort of close and were very interested. And I'd still say that our largest shareholders today are all very sort of responsive and very supportive, and they share that with the kind of ownership that we've had in the past, but they're perhaps not as sort of directly involved as the initial family, at least. And so that's digressed over time. I think it's natural when the founding families involved, they stay quite sort of involved directly, but as that moves over to more institutional capital, be it sort of large percentages, it becomes more passive, even though they're very responsive and supportive.
You use the term active shareholders for yourself. Maybe before we go into a definition, I want to go a step back. If you think about and I already talked with your analysts about this, that you're a listed company, but you're investing in private companies. So there's always a tension in between the information you want to share with your shareholders, that they are confident that you're doing the right decisions, and the information the companies you're investing in want to disclose. How you're going about this and how you're managing this constant struggle.
Well, I mean, the unwillingness to share information from companies typically is most sort of relevant or most sort of strong in the very early days, when, especially in the space where we are investing, where with network effects, we say that it takes about 5 years before you've built enough liquidity in a marketplace or enough data in other situations to be able to charge for your products at all. So in those early years, it becomes very important to share too much information, because there's still competition. Once you've moved out of that phase, the whole sort of idea here of very high barriers to entry being built, and makes it assume characteristics of winner takes everything. And once you've sort of achieved that, then there is no competition, right? And then it becomes more. They are able to at a more leisurely sort of rate share information. Like Avito went from sharing nothing to sharing revenue and margins and quite a bit of things. And so we are mindful of that with our companies. And whilst they are not in a position to share information at all, we instead then help our shareholders and trying to explain how we think about this investment, and to use sort of KPIs and metrics and data that's widely available perhaps from daily visitors or number of visits or that number of downloads, etc. So you can track sort of, that something is happening in the right direction. But then when the company starts to approach, a kind of dominant position, then we prepare them and to hold the hand of them to be able to successively start to share some information. And as you see in our portfolio today, Babylon and BlaBla have gotten to the stage where we don't share the same kind of information that we did for Avito in the end, but they let us share some information, and with that information you can build like a crude, even if it's crude, but you can still build some kind of starting point as a financial analyst of how the company is doing.
How you're defining the active and shareholder or inactive shareholders? Active,
I guess, stems from the early 2000s, where we were very active in the Russian capital markets. An active shareholder in Russian capital markets, where in these early phases of emerging markets, development, corporate governance is not understood. So we in the early days were very active about getting involved in situations which were very, very undervalued because of corporate governance risk, and then we were active about dismantling the risks of corporate governance. And so I think the activeness stems from those days, when it's more of a traditional even in the Western sort of space, that an active shareholder becomes a large shareholders, and then helps the management and the other shareholders to understand why it's important to think about being a good corporate citizen and good corporate governance. But that I guess has a relevance, not in the to what we do today, not because any of these companies are they're all run in sort of 100% good intent on corporate governance, etc. But it's we are active in other ways. So we're on the board of all our companies. I guess that's the most relevant sort of check for being an active shareholder. If you're not on the board, it's difficult to be active. Then I think we don't define active as running the companies. We try to be very clear to both our shareholders and also our portfolio companies that we are not going to run these companies. That's a bad idea. I mean, we've never run companies. We spend a lot of time on investing. When we do the due diligence of our investment work, we spend a lot of time on understanding that the founders don't need that help from its shareholders. And so active doesn't mean that we run the companies, but active is that we are board members, and we are very supported board members, for these companies as they sort of, go through the early innings of their life. And I think that's where we play a role in terms of activism. I think if you ask our different sort of entrepreneurs and founders, I think they felt that it was good to have us around, because it's a difficult journey, right? It's a volatile journey, and it never goes how you think it's going to go, never. And so to have someone there who's is going to be there as long as you are there, and that will always be supportive and someone to talk to. VNV guys are not someone who's are looking to take decisions to sell the company tomorrow. They're going to be here for the long term. I think that's a comfort, and I think we define activism in that way today.
How has the concept of ownership changed for VNV? Because if I look at the shareholders list, you're appearing there under the top 10 shareholders in my free snippets the first time in 2020. Did there something change in the concept of ownership? You're saying your team members should get more ownership over the years?
You mean, the way we think about ownership in our portfolio company?
No, how you think about ownership of the people working at VNV and owning shares of VNV and having shares as a compensation and the share orientation.
Yeah, that's always been the case, right? I mean, it's always been the case throughout the life of this company that the people who work here has been predominantly incentivized by by being exposed to the share. In the first sort of decades, we had simple stock options. Now we have it's essentially stock options, but it's structured in a way that's more standard here in Sweden. But it's very equity linked. And so over time, I mean, the shareholding of the people who work here, who have all worked here quite a lot. I mean, I've worked here the longest, but all the others have worked here for quite a few years. I mean, it's successfully become larger and larger shareholders.
How do you think about giving capital back to shareholders? Or you did two interesting moves. I think the spin-off of Vostok Emerging Finance was one, and then 1 or 2 years ago, you gave back a certain portion of the capital you did get from the Avito sale. How are you thinking about this and how you're going about this?
I think ever since I've been at this company, at least, we've been very disciplined with not sitting on liquidity if we don't have anything to do with that liquidity. We have all throughout the years been a buyer of our own stock in the market. If we trade at a discount to NAV, we've always been a buyer, and in that way essentially distributed cash to shareholders. And then since we are incentivized by the stock, we're not incentivized to have this company large just to have it large. I mean, it's not a fund. We don't have a management fee. We don't take a percentage of a large portfolio. So we're not incentivized for that. We're incentivized for these shares to go up in value. And if it makes sense to make it smaller for the one share to go up in value, then we'll do that. And I think that's very fresh. I think it's very important, and it's led to us distributing cash when we've had too much cash, or distributing assets when there was no need for our shareholders to get exposed to that asset through us. And I think that's also led us to believe that if we then, in a different scenario, have deals, investments that we think are in the interest of our shareholders to get exposed to, then we can go back and ask for this money. But then we, of course, have to explain that we're going to have to invest it into this company. This looks like this. It fits our strategy, and that's so I think that's worked well.
And how is your orientation about selling, also with reference to your shareholders? I think you have this law: if something is listed, you sell it, and if the founders sell their stake, you sell it as well, because shareholders can try to buy this themselves. Or what is the take on this?
Yeah, it's not quite a law, right? It's not written into our company charter that if something is listed, then we immediately have to sell it. We can hold listed assets, but it's not. We're never going to buy a listed asset, because you, as a shareholder or a big pension fund, they can do that themselves. They don't need us to do that. The cost layer of us. But if we have something that's in our portfolio that we've lived with as a private company that eventually lists, if it doesn't make sense for us to sell it, either because it's there's still upside, or for other reasons, then we can still sit on it for a while. But I don't think you should see us long-term sitting on assets that are listed. Then we either sell them or we distribute them to our shareholders.
That's an interesting way of going about listed assets. But before you have the chance to have something listed, you have to find ideas. And how are you going about generating or getting ideas at VNV? Well,
one thing is fixed in this volatile world, right? And that is what we invest, what we look for when we invest. So we look for network effects, and we define that as the product that the company sells becomes more attractive with every new user. With one new user, the product becomes a little bit better. That in turn attracts another user and makes the product a little bit better. So you're off in that spin. That's number one. Number two is that the markets that they are, disrupting or active in has to be large. And number three is that the founder has to be very strong and very able to navigate, things that will happen that we won't foresee right now. So that's fixed. But then you can apply this. I mean, we started in classifieds, which is maybe the holy grail of these network effects. It's a winner takes everything type of market. And but then we found this in other situations. We found it in BlaBlaCar, Delivery Hero. Those things are perfect for, they have the same characteristics. And we've recently also found it in terms of, the one who has the most data wins. But in those spaces, I think we've become quite well known in the concept of network effect. So we get deal flow, i.e., ideas what to do from founders who come to us because they've seen us, as owners in other companies. VCs, we don't really compete with VCs. We don't raise money from the same people. We typically stay longer than VCs, so they don't see us as competitors. We have a relationship where we invest alongside them, and then sometimes we seek out situations ourselves as well. So it's from a the ideas come from a variety of different sort of sources.
You're having assignments in a few other companies that are shown if you're going on some portals that show them, like for instance the org.com. How helpful are these assignments? I mean, this list, I'm not sure if this is the correct list, but
oh yeah, okay, I see what you mean. Yeah, no, exactly. There's some. I mean, most of these things are very, very small private situations. I do invest some privately outside of Vostok. Nothing that sort of competes with Vostok. That's, I think, law. But I'm very interested in music. I have some investments into music. That's the main thing.
Are these investments helpful for the work at VNV, or are they a separated sphere?
Some of them are helpful in terms of a network of expanding the network. I think in that sense they are helpful, but otherwise they're more it's a company is a company, and you can see that there's some benefit from. You always learn when you're involved in different companies and they have troubles or they have wins, but it's indirect like that, the benefit.
And if you invest in music, just one question: what's your favorite music, or do you have no favorite music?
You mean in terms of type of music,
yeah, type of music.
Investment into music,
or what type of music you like most? If you're
I'm born in 1969, so I think the music we listened to when we were in those very formative years of 13, 14, 15, 16, that sticks with you. And I grew up looking at this Irish band U2 playing in Germany. I saw it on Swedish television and I got fascinated by that. So I think if you ask me, U2 and Springsteen I think I've seen those two groups 40 times over the years, 40 concerts. And so those will be the main ones.
Interesting. I also like them. But coming back to the ideas is also like a bit like music selection, that you want to have a good music you can stick to and sort them out because there's so much offering. So what is your way to find on ideas the needle in the haystack?
On ideas for investments?
Yeah. For VNV.
I mean, I think you have to be curious. Curious about new things. I think you have to be, positive and receptive to new ideas. And if you are that, then I think that attracts people who are interested in building new things, and then you get exposed to people that come to you who know that you are, the door is always open. They may not always invest, but they will pretty much always listen, and that gives you a lot of inflow of ideas. and then to sort of to choose which one, you learn over time, I guess. Often these companies that we invest to are so young, so there's not a lot of data to go through. It's not a lot of history and annual reports, etc. So you have to form a view in using other sources, spending time with the people, mainly, looking at the markets.
How important is management in this process? The people, especially if the companies are smaller, I think that management plays a more important role compared to bigger companies.
No, I mean, you're 100% right. It's everything, right? I mean, especially when you're investing in these young companies and young companies active in spaces where they're sort of disrupting old industries, right? You don't know, like we're in health today. And, I think we all agree upon that, the health sector will be more digitalized in 5 years and in 10 years. But, to understand exactly now how, what kind of business models, how will, who will pay, what will be important, the visibility into that is very, very low. So you have to have management who's able to adapt and maybe have to change the direction from there to there, in terms of, the focus of the company. And so management is the most important here. Absolutely, super important. I think where we have been very successful in terms of investments, the common denominator amongst those are that the management has been that very strong, very strong. It sounds like they're just strong in terms of muscular, but very intellectually sort of creative and have a lot of persistency, but also been able to adapt a lot. So the ones that have been successful, there's been management who's had characteristics like those, and others where we have failed, it's often been that we've been wrong about the management, that they didn't have the sort of all these things that we thought that they maybe had when we invested.
Is there some character trait over the years you found I shouldn't invest with people that are like this?
That's difficult to say. I don't think there's no ABC rule book on that. You have to spend time, and people can be different, but still have it.
You mentioned the other sources you're looking at to understand companies that don't have a big history, but you're interested in investing in. What are examples for these other sources?
Well, as you said, I mean, first and foremost, management and the people that they have sort of gathered around themselves, and then we try to get to know them by spending time with them, but also spending time with people where they've been in the past, understanding them. But other more quantitative sources are perhaps if they have a product that's sort of been tested somewhat, you can look at how many downloads, traffic, conversion. There's data that you can analyze. You mine that data and you get a better picture of how they've fared so far.
In some of your investments, and maybe if I'm thinking about Avito, with this characteristics of the market, only the sky seems to be the limit. If you're assessing a company and getting to know them, how much do you want to look into the future, or what kind of picture are you forming about the future the company can have, and how you're thinking about optionalities on this way that are coming up?
Yeah, sometimes it's easy, and this concept that you took us back to, of what works in the West will work in the East, is that also for Avito we looked at Schibsted, and we saw how much revenue there was per every user in the Schibsted markets, and we saw that at Avito it was 1/100th of that, and that was not relevant. It should go up. But in many cases now, especially now in our portfolio, we are in companies that are global leaders, in the space, so that there's no one to benchmark against. And then it becomes more difficult, right, to know how does it look at maturity? How does it look when you're done, kind of thing. And so then you have to form a view around that in other ways.
What role do optionalities play for you if you're trying
optionalities, right?
Find a
That's what you
try to value the company?
Yeah, it's all about optionality, right? Typically, a startup is an option. But beyond that, we typically don't put value on the optionality and see that as upside. So that I don't know what's a good example, but Avito was a company focused on Russia, and they were so strong in terms of tech and knowledge about running this space and building this space in emerging markets, so that they at some point of time also decided to apply that to other emerging markets. And that was obviously, that's optionality on the upside. We never really valued that, but if it worked, it worked, and then that would create value. And the same is present, I think, in the companies we have today. Voi, for example, is the European leader in e-scooters. They have applied for a license in New York. That's optionality on the upside. We don't put that in our, the model we make when we decide of how to invest into Voi. But if it works, it's optionality on the upside.
You already mentioned that thinking about risk and reward is something that's, I can wake you up in the morning at 3 and we can talk about risk and reward if you're happy to talk with me at this time. What kind of risk of a reward are you looking for in a company, in an investment?
Yeah, well, I think we looking at network effects, very high barriers to entry, right? I mean, like businesses you want to own forever. And then apply that to very large markets like classifieds in Russia, for example. Very large market. 150 million people. Large GDP. So the potential is there. I think we that's our starting point. Think that this if this works well, this could go up 100 times or 50 times, etc. And then okay, so what risk do we have to expose ourselves to be exposed to that upside? And then we sort of look at that. We probably have to put in this much money. We could lose it all. And then we put the same amount of money again, and then you basically see if the risk reward stacks up. So I think that's, in a crude way, how we go about it.
Then maybe let's go have a look again at the portfolio. Maybe help us to understand if you have smaller positions like JobNet, 0.1%. Are these the small bets where you're thinking they would double, or how you go about these positions in the portfolio?
No, the small bets will go many, 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 many times. So we typically start small. Since we get involved, we can get involved early. We can get involved late also, but we can get involved early. And you get involved early in this space where it takes, our rule of thumb, it takes 5 years before you have any revenue at all. It becomes a very, the companies are subject to a lot of risks in these first 5 years. Hopefully, slowly coming down, the value coming up. But the point is that the value in the beginning is low. The tickets are low. And so we get, so hence they don't measure up very much in the portfolio. But if they perform as we hope and think they will over these 5 years, then there's enormous leverage on the upside on them, and they will grow as a part of the portfolio. Avito started as a $4 million investment. It ended up being a $540 million investment. And
that's more than doubling.
That's more than doubling, yes. And then but when we started Avito, when we put that first money in, it was 0.1% of the portfolio, if that. I remember the family owned it. They said, Per, they called it Per's kindergarten. Play Per can play with these things. There's no assets, it's nothing. But anyway, but if you don't do the small things, you miss the big things, and the small things grow. So we have now a portfolio of, what is it now, 4 or 5 names that make up about 75% of the portfolio. And those 4 or 5 names, you would have mentioned them if you talked to me 2.5 years ago, when, we had large holding in Avito. They were in the shadows of Avito. And in the same way today, we have companies that are in the shadows of Babylon, blah, blah. And, in time, they will come out of that shadow. So small things grow.
You mentioned the kindergarten picture about the portfolio. Is there any picture you're using to describe your way of approaching the portfolio? Sometimes it's a soccer trainer who sets up the team and puts someone on the offense, or it might be the gardener who sets small plantlings that become to big trees. Or how you're going about the picture or the composition of the portfolio?
No, the composition of the portfolio we don't think so much about, and I try to be very clear to our shareholders also about that we're not going to build a diversified portfolio for you. If Babylon were to list and were to double, it will be 50% of the portfolio. Fine, we're not going to. And if we think it will go another 5 times from there, which we think, it will not. We will keep it. And then we're not going to sell it down so that it's exactly 1/3 of the portfolio, or exactly 25% of the portfolio. So, we sort of adhere to this old concept. I don't know who said it. I know Barton Biggs or Morgan Stanley used it a lot. Maybe he minted it, but diversification kills the performance. And you have to be able to understand the risks you have and not hide behind diversification. Anyway, I know the mathematical sort of benefit of diversification, but we don't, we try to be clear about that. So if, we run a portfolio that's obviously subject to a lot of risk and also, I think very impressive upside. But if you want a diversified portfolio, you have to do that at the shareholder level. That's to the extent of the composition of the portfolio. But you said something else as well. Remind me.
Your picture, how you're going about the portfolio.
I recently wrote a piece about tennis. Apart from music, I'm a tennis fan, and I don't know, you don't see my tennis racket here, but anyway, it's behind me. I plotted our portfolio in terms of tennis players, and this is very nerdy, and forgive me for that. But if you think of Facebook, I love nerds. I think nerds is important, and I'm very nerdy in my things. And with the risk of being nerdy, then that I would describe the tech world as we don't invest into the Nadal and the Federers and the Djokovic's. They are the Amazons, and they are established and very large. We invest into the very young players, and sometimes these young players grow up to the extent that Babylon is a leader in its field for in where it's playing, but it's not reached its full potential. So this is like like the German player Alexander Zverev, for example. He's one of the best in the world, but there's much more potential. He will be number 1 in the world, I'm quite sure. And the same goes for Tsitsipas and Dmitry Medvedev. But then also in the portfolio we have the stuff that's in the shadows today of the Medvedevs in our portfolio, the Babylons. We have companies like Swivel, Dostavista, and Booksy, which are all we don't hear about them much. And these are you could compare these to some of the younger players like Korda, for example, or Jannik Sinner. But then we also have very young players, people who are kids, basically. And those are the 0.1s in the portfolio. And there's risk with them. Maybe they don't make it to the top in the world. But if they do, there's lots of potential.
What do you like about this next-gen stars compare, or like Dostavista, Booksy, and SVL? What do you like about them, and what made you invest in them?
Well, I mean, first and foremost, we have three that we call the next gen, right? It's Dostavista, Booksy, and Swivel. I mean, all three of them, they very much enjoy the potential of network effects. They are one more user makes their product a little bit better, and that attracts more. And they all have that. I mean, Swivel is essentially a bus platform for large emerging market cities. Booksy is a marketplace for beauty industry, very, very, large, which is larger than the food industry. It's very large. And then Dostavista is a marketplace for last mile delivery. And so all of that, and then very, very strong founders. Dostavista is Russian. Booksy is run by a Polish guy who now lives in America, is very focused on America. And Swivel, I think, is run by perhaps the strongest tech entrepreneur from the Middle East that we have today, Mustafa Kandil. So they're very strong, and they're going after enormous markets.
What does make these people strong, in your definition?
Well, they are. I mean, they are like we talked about before. I mean, they're very passionate about what they do. To the extent that they have a lot of patience, and this is what they do in life. I mean, as you and I spoke about, they're perhaps nerds about what they do. They've spent a lot of time thinking about this, and they're very, very focused on it. But then they also are, they don't have, pride in that negative way. That if no, the ship is going this way, and even though it might be better to go that way, I'm still going to keep this way. So they said this was wrong. We have to go that way to succeed, and they will. And so they're humble, I think, in that way, which I think is super important.
How much does data play a role for decision making of these people and all investments in your portfolio?
Yeah, I think that's a very common denominator. I mean, I think all companies we have are all take decisions based on data. They're data driven, very, very data driven.
That's good to know. When you think about the established players, you already mentioned Voi and Babylon. What is the interesting thing about Voi? There might be the public image of some of the viewers that are just the scooters standing around the corner, and they are trashing the inner cities. But what is in your eyes interesting in Voi? Well, from our perspective of investing, what's interesting is that they possess this concept of network effects and here it's more difficult to see maybe, but it's really quite simple in that you will not take a Voi or a Tier or whatever it is if it's not outside your door. If it's 5 blocks away, if it's 500 meters away, I mean, you will go about your travel like you did before these things were present. And the only reason it can be outside your door is if I have taken it there to come and visit someone in your building or visit you. And so the one who has the most users will have its scooters most spread throughout the city. And if they are more spread so that they are outside your door, you will have more users, and more users will make them more spread. And so it's very, very clear that in Voi is a leader in pretty much all the markets that they're in. And here it's very clear that they have a certain amount of scooters percentage-wise, but they have a larger percentage of the revenues than they have a percentage of the scooters. So for every new scooter they put out, the revenue goes up on all the other scooters they already have out. And so I think that's for me as an investor in investing, in what we look to invest into, what we do, that they very clearly check that box. But then I think also the revelation there is then how popular this has become, both from consumers but also from city councils. People want to move around the city with less and less cars.
and the city councils, because of their voters they want to reduce the number of cars inside the city, and this fits very well into that. And of course, it's the most efficient means of transportation in terms of the environment. There is the only thing that's better is the metro. But what this gives you that the metro doesn't is that it gets you point to point, right? It's not station to station; it gets you point to point, and that's, I think, is very attractive for people. So this has become infrastructure. This I didn't understand this when we started it, but now it's infrastructure. It's infrastructure that's licensed in the same way as maybe as a toll bridge is licensed, which makes it also quite interesting. If you think that at the initial point that this would be owned by, the Ubers of this world, or this is now, I think, could be owned by the same people who own a toll bridge infrastructure. So
will Babylon also become infrastructure, or where do you see the trajectory there?
Yeah, in some way you could describe it as that, but it's not as clear as it is with Voi. But what I think is very clear is that that we all agree upon that the health space, I guess, is the last very, very large sector that is yet to digitalize. The online penetration of primary care today is like reminiscent of e-commerce in 2000. It's 1%, and I think it's going to be 100%, over time. It's a very, very large space, but I think it's the visibility again into exactly what is it's not super high. So you have to back adaptable players, and you have to back players that digitalize this properly, because also it's very expensive, the healthcare system in all our societies, right? The kind of countries you and I come from, but also in the US, it's even more expensive. So you have to, and 80% of the costs here are in some way from employees. So in order to make this more affordable for people, you have to properly digitalize it, and there Babylon is the leader. So I think it will become the heart of many sort of health systems in the world. And in that way, maybe you could call it infrastructure, but there's some different aspects to it now. So,
what makes them the leader?
Well, I think there's no one who's applied this concept of AI to the extent that they have, and also there's no one who has been able to sell an AI-based product to the same amount of clients and very, very large institutions. Their customers are the National Health Service in the UK, TELUS in Canada, Prudential, Centene, Bill Gates Foundation. These are all institutions and companies that are able to understand very clearly what's the best product out there, and they are able to become a customer of the best supplier out there. Bill Gates, Prudential they're world-class institutions, and they've all chosen Babylon, and they've all chosen to extend their relationship with Babylon. So I think that sort of is, there's no one else who's done that with this pure digital product.
But isn't that
at the heart of the business?
Isn't that super hard because healthcare is such a national thing?
It is hard. It is hard. But if you want to fix the simple things, you're not going to. That's easy. This is hard, but it also means that the upside is large.
It is. Where do you see Babylon in 3 or 5 years?
Well, I think they will still be building their products. This is a company that built product for 5 years before they had the first customer, and so they will still be spending lots of investments of continuing to refine their product, because even in 3, 4, 5 years, we're not going to reach the end game of this, right? So, but they will have. In that number of years, we'll look back to that. They will be a multi-billion euro revenue company, And so they will really have proven up that this works, and this is in demand. I mean, they're all already today, and have large revenues, but in that number of years there will be a proper. It will be much larger. I think it will be very U.S. centric. The U.S. is, of course, a very broken healthcare system, and one that needs a lot of attention. And it's very large, so it's natural for the company to focus there. They're focusing there, so we'll probably call it an American company in terms of their markets, but it will be based out of Europe. So I also think it will be listed in that, certainly in that number of years. So a listed company, multi-billion-dollar revenue, very US centric.
How high is the chance that you're still being on the side of Babylon then, as an active shareholder?
I think it's quite high. I think it will be listed. It will be a very large company. I think it will be a $20 billion plus sort of market value company. I think at that point in time, there is a risk that we may have distributed the shares to the shareholders. But I'll keep mine.
We will see how it plays out. We will see. Yeah. Going a bit further up with the outlook, or going away from Babylon, which areas of new investment opportunities are you currently gravitating to, where you find interesting ideas, optionalities you want to go deeper into?
Well, we invest bottom up, so we look for these three things that we continuously come back to: network effects, large markets, and good and strong founders. But that has led us to three sort of big macro themes. Classifieds was where we started. We still have some of that, classifieds/marketplaces. But then we have a lot of stuff going on in mobility, which is a strong macro theme in itself that we've touched upon, right? With cities becoming non-cars and that macro theme drives the large market. But hand on the heart, it's the network effects company that we've been looking for, and that's led us into that market. And the same goes for digital health. I mean, digital health is something that's a macro theme that's so strong, and it's been accelerated enormously by COVID. But that's going to continue for a long time. But we are there because we found companies that can build very high barriers to entry. But if one allows oneself to sort of expand what we see today, that there's more and more opportunities that we look to, which are in the intersection of these network effects and a macro that has to be described as a climate macro. And so we have a very fascinating opportunities around food waste, agri-tech, the way consumers are looking to sort of source stuff locally, and marketplaces around that. That we are very, some of them we are already exposed to, but there's an increasing amount of activity there. So that may be a description of a new theme, if you will.
Where do you see there the network effects coming in on the relation to climate or efficiency?
Well, food waste, for example, there's a marketplace for food waste that we are very, very excited about. So that's a marketplace, right? Fragmented demand, fragmented supply, lots and lots and lots of liquidity in the middle.
30% of the food is wasted or something like this.
No. I mean, it's a horrible amount of food that's wasted in the world that we have to, fix. If it's very, very, it's very, as part of, us being, taking care of this planet better. But beyond that, I think we see a lot of data plays around agriculture, which are perhaps global niches, small niches, but on a global scale they become large. And here it's sort of the network effects come around the same way as Babylon, for example, that the one who has the most data will win here. that farmers will go to the company that has the most data, and then that gives them more data, and then you're off in that spin. So there's a couple of opportunities like that, weather data, other types of data. And then there are other marketplaces like your local corner store. You go there and you probably want to buy apples from your local orchard, but your local corner store has no market ability to source that efficiently. They can't go out and sort of, contact all the local farmers directly. So there's quite a few marketplaces coming about, which helps your local store to source local apples, but without, and still do it efficiently. So those kind of opportunities are very interesting too.
That's quite interesting. Looking 5 years out, where do you see VNV Global then? And might there be a chance that you have another name, or are you staying with VNV Global?
No, I think VNV Global is where we'll stick. It's we decided to drop the Russian-sounding Vostok, not because we don't like Russia or like investing in Russia, but because we had so little in Russia, so that we sounded like we were only about Russia. But VNV Global, I think, is generic enough. I mean, that doesn't put us in one bucket. I think we'll do what we do today. I think in that number of years, I think there'll be 5-6 companies that probably are in the portfolio now that are quite large in comparison to what they are today, in percentages of the portfolio, that will have grown up, that will become top 10 in the world in terms of tennis. But and there will be a lot of new ones. I mean, we started a scout program last year, where we have a handful of scouts that we know very well, we trust very well, and they know us very well, and they're typically entrepreneurs themselves, so they get a lot of asks from other young entrepreneurs for help, and those young entrepreneurs are always fundraising. So if the scout decides to invest, we say we'll invest 5 to 10x what they invest and give them a little part of the upside for handling. And so our ambition is that we'll have 10 scouts, and each scout will build a portfolio of 10 companies. So we'll have 100 very young companies in the portfolio, and then as they hopefully grow, then we'll be able to invest.
You have a very lean team. Do you see a chance the team will grow as well, or are you going about the growth with the scouts?
Maybe the team will grow somewhat, but I think we are all much more interested in running investments than running people. So we like this concept of using the network here. All these scouts, for example, are people that we've known from portfolio companies or in the industry, and so it's more efficient for us to use a network of people to do the work that we can't do in-house.
That's interesting. I'm fine with my questions at this point. Do you have something to add we haven't discussed, or you think that it's a good closing word for the interview?
Yeah, no, I don't have a like a not really. I think we talked about a lot. Your questions were very good. We are about taking risk, right? So it's typically a volatile journey, but we're very, very focused on not taking risk if the upside is not enormous. So the risk reward, at least I'm very confident about, is very good. And then it's also, when that's the case, it's good to be long term, I guess. It's the other important factor here. You could ride out the volatility.
Thank you very much for the interview and taking the time, and thank you very much for the audience listening to it. Thank you, and bye-bye.
Thanks. Bye.